Have you ever wondered which part of the world could outgrow everyone else between 2025 and 2027? Picture a region where digital wallets, new railways, and reform-minded governments collide, creating a growth boom that could surprise global investors. Today, we're breaking down why East Africa, not one country, but the region, is shaping up to be one of the fastest-growing economic hotspots over the next 3 years, and exactly which reforms, sectors, and policies will drive that surge. Stick around. There's a lot here that could change how you think about opportunity in Africa. And I want your hot takes in the comments. Which country will surprise you most? Short version: multi-year macro forecasts from institutions like the World Bank and AFDB already point to faster growth in East Africa than many other African regions, and that momentum isn't random. It comes from a clear mix of policy reforms, fiscal consolidation and debt management in some countries, market liberalization and currency reforms in others, plus high-impact investments in agriculture, big-ticket infrastructure, and a rapid digital transformation that's lowering the cost of doing business. I'll show you specific reforms, point to the sectors that will compound growth, and explain how trade and regional integration act like a turbocharger for the whole region. Here are the numbers that matter. The World Bank's regional workbook and analyses highlight that the East African community and the broader Eastern and Southern Africa bloc are projected to accelerate growth into the mid-2020s, with some forecasts putting East Africa's average growth rates well above continental norms in 2026 to 2027. The AFDB's African Economic Outlook also argues that properly sequenced reforms could unlock huge domestic resources and lift growth strongly across the region. Those are not feel-good predictions. They are the result of actual policy shifts and investment plans in place now. Driver 1. Macro and policy reforms that restore investor confidence. First, macro stability and creditor negotiations matter. Several East African governments have moved to tighten fiscal policy, restructure debt, and reduce domestic borrowing to avoid crowding out private investment. Uganda, for instance, has announced spending cuts and measures to lower domestic borrowing so it can free up resources for infrastructure completion. That's the kind of fiscal discipline investors like to see. At the same time, countries such as Ethiopia have moved to liberalize their currency and open sectors to foreign banks and investment. The kind of structural change that turns previously closed economies into growth magnets. These aren't one-off headlines. They change the investment calculus for multinationals and local entrepreneurs alike. Why that matters? When governments show credible plans to manage deficits and debt, interest rates and lending conditions stabilize, unlocking private credit and lowering the cost of capital, which feeds into investment in factories, farms, and tech startups. Driver 2. Agriculture modernization. Productivity plus value chains. Agriculture still employs the majority of people in many East African countries, so even small productivity gains have outsized effects on GDP and household incomes. Governments and donors are pushing modern inputs, irrigation projects, storage and cold chains, and agro-processing facilities to move crops up the value chain. That means more export earnings, better food security, and a faster route from farm to factory. When you combine agricultural modernization with better roads and ports, entire value chains become more profitable. And that's a direct growth multiplier. The African Development Bank and World Bank both highlight agriculture and rural transformation as central to raising continental growth, and East Africa's national plans reflect that priority. Driver 3. Big infrastructure projects. Connectivity unlocks markets. Next, infrastructure. Think railways, ports, fiber optic corridors, and regional highways. East Africa's mega project pipeline, From standard gauge rail to interconnector power projects to planned oil and refinery investments, is designed to slash logistics costs and link producers to export markets. Uganda and Tanzania's pipeline and railway ambitions, plus cross-border power and transport projects, create an environment where manufacturing and trade can scale quickly. When producers can get goods to market faster and cheaper, investment follows, and the result is visible in regional growth projections. Driver 4. Digital transformation and fintech, lowering costs, increasing inclusion. If you've been watching mobile money and fintech in Kenya and beyond, you know what I'm about to say. Digital payments, cheaper access to credit, and expanded internet coverage are changing commerce from the street market up to the export factory. The World Bank documents how digital projects are expanding access in Ethiopia and elsewhere, boosting financial inclusion and enabling new business models. Startups and digital platforms scale fast. They don't need the same physical capital as factories do, but they still have an outsized economic impact when regulators create a supportive environment. That's why digital policy reforms, from clearer telecom regulation to open banking rules, are growth catalysts. Driver 5. Regional integration and trade. Bigger market, more competition. A small economy grows fast when it can sell to a bigger one. Regional integration under bodies like the East African Community, EAC, and through broader African frameworks reduces trade barriers, harmonizes regulations, and encourages cross-border investment. The EAC's recent budget and activities signal a push toward private sector-driven integration. Combine that with AfCFTA, where implemented, and you get scale. Manufacturers can serve a billion-plus market rather than a single country. That changes where factories are built and where logistics hubs go. And that change multiplies growth across multiple economies. Case study: Ethiopia. Opening markets plus large-scale investment. Ethiopia is a standout example. After years of tightly managed economic policy, recent reforms, currency adjustments, state-owned enterprise restructuring, and steps to allow private and foreign participation in telecom and banking have encouraged fresh inflows of capital. The government and IMF-backed programs point to higher projected growth in coming fiscal years as these reforms take hold. For investors, Ethiopia's combination of a large domestic market, improving macro policy, and infrastructure investment is a powerful attractor. But reform sequencing and political stability will determine whether projected gains materialize. Case study: Kenya and fintech. Scale from innovation. Kenya remains a digital leader in the region. Mobile money, a thriving startup ecosystem, and continuous private-led investment in fintech and logistics make Kenya a regional hub. As neighboring countries adopt interoperable systems and regulatory frameworks that support cross-border payments, Kenya's digital ecosystem will push growth across borders, enabling small businesses everywhere in East Africa to sell, receive payments, and access credit much faster than before. This is not just hype. It's already impacting trade and services. Where the risks are. Let's be honest, predictions aren't guarantees. East Africa faces real risks: commodity price swings, climate shocks affecting agriculture, potential political instability in some states, and the timing of reforms. And while some countries are managing debts and cutting deficits, others still carry heavy public debt burdens that could limit public investment if global rates or capital flows shift. The African Economic Outlook stresses that reform sequencing and governance are crucial. With the right sequencing, the region could mobilize substantial domestic resources and accelerate investment. With the wrong timing, gains slow, so growth will be uneven. The headline may be "East Africa accelerates," but the story will still be about winners and laggards inside the region. How investors and entrepreneurs can position for 2025 to 2027. If you're an investor or entrepreneur, here's the practical playbook. Look at sectors that benefit from network effects: digital platforms, logistics, and payments. Target value chain plays in agriculture and agro-processing. Think warehouses, cold storage, and export packing. Consider infrastructure-adjacent opportunities: construction, maintenance, and services for ports, roads, and power projects. Watch policy windows. Countries with IMF or AFDB programs often open procurement and sectors to private capital as part of conditionality, creating entry points. And finally, partner with local firms. Local knowledge and relationships still unlock the best deals. Each of these moves is grounded in the reforms and investments we've already talked about, not in wishful thinking. A quick timeline view. What to expect year by year 2025. Expect steady acceleration as fiscal tweaks, digital projects, and infrastructure continuity push GDP slightly higher across the EAC. 2026. Reforms and infrastructure begin compounding. Certain countries should show sharp growth upticks as private investment returns. 2027. If reforms stick and regional trade deepens, parts of East Africa could be among the fastest-growing regions globally, driven by the combination of digital scaling, agricultural modernization, and improved logistics. These are the years that will make or break long-term narratives about the region's economic trajectory. Again, conditional on reforms and geopolitical stability. So will East Africa be the world's fastest-growing region from 2025 to 2027? The data and policy moves suggest it's a real contender. The combination of macro stabilization, digital transformation, agriculture value chain upgrades, and major infrastructure projects creates a stacked deck for growth. But the deck is only as strong as governance, reform sequencing, and global conditions allow. Which country do you think will lead the pack? Ethiopia, Kenya, Rwanda, Uganda, or Tanzania? Drop your pick and why in the comments. I'll pin the most compelling argument. If you liked this breakdown and want more regional deep dives and investment reads like this, hit subscribe for weekly money route analysis. Click the link in the description to watch more videos like this. Thanks for watching, and I'll see you in the next one.